Welcome to the Homeownership Podcast presented by Momentum Realty, located in Hanover, Massachusetts. This series covers all things real estate and the best practices for buying, selling, and owning properties. Now here's your host, Sean Maloney.
Welcome to episode 169, Why Do Interest Rates Affect Pricing? I'm your host, Sean Patrick Maloney. Thanks for joining me this week. This week I want to talk to you about something that's kind of becoming more present in the market as we speak. Interest rates are climbing. We had historically low, all-time interest rates where people were basically almost getting money for free, borrowing at rates in the low threes. It was a great time and prices were just absolutely surging. Now we're starting to see rates climb, and I want to talk to you just a little bit about what this can mean to the marketplace and why does that interest rate affect pricing. Like, what kind of effect would the interest rate increasing have on prices? So a slight uptick in rates can mean a major downward trend in purchase power. The interest rate goes up, so doesn't the monthly payment. It's a pretty easy to understand concept, but a lot of people forget that in the United States, everything is about monthly payment. So when that monthly payment becomes unaffordable, then the purchase price needs to come down. This is what consumers expect of any product. It doesn't matter what it is. If I can't get what I need out of your product within my monthly purchase price, then either your price needs to come down or I'm not a buyer, which means as the buyers slowly but surely kind of dissolve out and no one can afford it anymore, you either choose to reprice your inventory in this case being your houses, you either reprice or you deal with the consequences of not selling. So for sellers sitting out there on the fence about whether now is a good time to sell or not, as interest rates have begun to climb, if you wanted to take advantage of this massive opportunity of marketplace right now, it may be the time to do so because, again, remember, it's all about what the consumer can afford. Not saying your house isn't worth it, not saying you don't have a great house or there's anything wrong with your house, but a person's ability to perform actually is what dictates the marketplace. And in a heavily financed world like the United States, we have people living off of every single paycheck, living in huge homes. And that's because as long as they can make that monthly payment, they can afford that home. The monthly payment thing is quickly offset too. Like if you go over those numbers, so let's just talk about it. Like a 1% rate increase on a $500,000 purchase means that the monthly payment goes up by $288. That can quickly disqualify people, which means that the price overall is going to end up going down, right? And we know that a 30-year loan is going to be a 360-month payment. If that payment went up by $288 over 360 payments, which is 30 years, you're talking an increase in total cost of $103,680 over the course of 30 years. Those are real numbers, folks. These are not small numbers. So let's just give you some examples. So $500K financed at 3.5% is going to be at $2,245 a month. Same deal, but at 4.5% is going to be at $2,533 a month. That same exact house at 5.5% is now going to be $2,839 a month. You can see how quickly that this can outpace people. But again, also it's like, you also have to realize as those rates increase, you're paying more for the home because you're paying more for the finance, which means that overall you have to be okay with those numbers. So that house that seemed expensive before that you were, annoyed by, oh, that's too much money, now is even more too much money because the interest rates climbed up. So you actually could have bought it at a lower cost to you by purchasing when the interest rates were down, which means that as these interest rates climb, it's going to affect pricing drastically. We're going to see some cooling. Do I think we're going to see a downward spiral? Do I think we have an 07 event as of current? Probably not currently. We're pretty close to it in the idea that we have almost a world war going on and we have interest rates climbing so fast and inflation at all-time highs. That said, no one ever knows where the market's going. Even the people over at the Fed and all them, they can tell you that they know. But there are so many variables in the world that can come and change things that I wouldn't be one to put it on. But I would say if you're a seller and you're on the fence, should I sell or not? Now is the time, especially if you have that ugly inventory. You have that corner lot on a main road. You have that house that needs repair. You have all these different things that in normal conditions would be difficult to sell. We still have a great market out there. and I would highly recommend taking advantage of it. And then as a buyer, if you're sitting there saying the houses cost too much, go and do the math of the climbing interest rate and look at your monthly payment, and be very careful there, folks, right? Don't sit back and wait to execute. Make good offers. I know right now we're still playing bidding war quite often. Putting in offers that are not going to get you a win is just extending out the amount of time you're renting for or not moving for, and also extending out your risk that the interest rates will climb. Now remember, when buying a house, we're not buying a rate, we're buying a home, and rates go up and they go down and they go left and they go right. So if you don't like your rate today, there may be a time in the future, no guarantees, but there may be a time in the future where it dips back down, and that's when you use what they call the refinance. The refinance is where you take your current financing situation, you pay it all off, and you move into the new terms maybe at a lower interest rate. That's often why people will refinance. There's cash out refis where you take the money out, but right now we're not seeing a lot of refis anymore. Why? Because again, as the market continues to chug along, everything's going well on the purchase side. The refis are only good when the interest rate is lower than the current interest rate. Some refis going on for the cash out refis where they may be putting additions on, different things like that. But we are seeing that most people took advantage of those very low rates, those historically low rates that we had just a few months ago. Guys, I hope this helps you understand how much the interest rate affects pricing and how important it is for you to execute and get a deal going today. Thank you so much for listening to the podcast. If you need help understanding this further, reach out to us over here at Movementum. We'd be happy to connect you with one of our Move mentors who can help you guide you through the whole process of buying, selling, or just owning a home and understanding interest rates. If you haven't already subscribed to the podcast, make sure to do so. Tell everyone you know about it. Also, check out our blog that's put out weekly. Great information on buying, selling, and owning homes. Thanks again for listening. I look forward to talking to you next week.